Welcome to the 10th episode of How to ThinkScript. We are TOSindicators.com, home of the volatility box. Using the volatility box, we made $2,400 last week trading a 2-lot in a small account. Our goal is to make the volatility box the single most powerful indicator in your trading arsenal. If you'd like to sign up, head on over to TOSindicators.com/volatilitybox. We still have a few spots open at the discounted monthly rate of $127 a month, after which the price will increase. As always, you have a 30-day risk-free trial. If you don't like it for any reason, just send us an email and we'll give you your money back. Today, we have something very special planned for this tutorial. One of our members, Keith, sent us over a dynamic RSI indicator that he had built in thinkorswim. He's been working towards his goal of becoming a full-time trader, but currently works in sales and has been trading for almost 15 years. So Keith, cheers to pursuing and chasing after a dream, and after this tutorial, I think all of you watching will also agree that Keith has something pretty special here that you might be able to use in your daily trading as well. So in today's video, we'll take you through the process that Keith and I took in taking his initial code, observing it, and turning it into something that we can actually use to trade with. Here are some concepts that we'll discuss in today's video. First will be the idea of layering on other indicators within one. And so in this case, we'll be talking about how to layer in the RSI along with the Bollinger Band, along with what we'll call the dynamic average. Another concept we'll learn is integrating outside code as modules inside of the existing code. And for this, we'll use trend lines codes that's available on the internet, created by Mobius. Another concept that we'll understand is really just how to present this study. And that's where we'll try and create two different studies, an upper and a lower study, which show us different information, sometimes the same information, but in different ways. And that will just be a concept about how to present the indicator. And then finally, we'll talk about how to translate patterns and observations into an actual plan. And this is where a lot of our coding comes in. And then Keith has also gone ahead and created a single one-page Word doc, which I'll go ahead and include with the indicator download file. So the way we'll lay out this tutorial is there will be a before section in which we'll talk about some of the patterns and observations that Keith has been sending us. And so I've copy-pasted his charts that he sent along with some of his commentary. And so we'll use that to understand first off, how does he trade the dynamic RSI and what are some patterns, right? There's the indicator with a lot of lines, and you'll see that there's just, it may confuse you or overwhelm you, especially if you're used to, say, having nothing on your charts. But we'll talk about how we can extract information, what does Keith use, and then decipher those into actual code in our tutorial, right? So that's where we'll take his insights and we'll translate that into something that's easy, something that's consistent, and something that's objective that the indicator does and just tells us sort of when there's valid signals, yes or no, and then gives us information in terms of overbought and oversold. And then finally, at the end of this tutorial, we'll then compare the before and after on charts, and then we can also talk about just some areas that you might want to continue to improve this indicator on your own and take this one step further and modify it for your own trading style. Okay, so let's start first with the before, and this is where we look at all of the patterns and the insights that Keith has been sending us with his comments and try and extract things that we can then use to translate into real code. Before we start, I'll start by highlighting 5 key takeaways that I think Keith has been sharing with myself, and I think you'll see are consistent themes. Some mentioned in the charts and then some not, and so we'll just discuss these first. The first is drawing a trend line on the RSI and buying any support off of bounces on the trend line or identifying breaks of it has really been the instrumental part. And this is where my first reaction to Keith was, oh man, trend lines are a bit more subjective, right? People can draw them different ways. And what we've done in this indicator is figured out a way to make that an objective process, and you can just use that to determine whether or not it's really a bounce into the trend line. The second is the longer the time frame, the less choppy the RSI is. We're used to seeing this, but I think that it's important to acknowledge that this is just what an RSI looks like. And so yes, if you do go from a 3-minute to a 5-minute to a 10 to a 15-minute chart, the RSI will just get less choppier and be a little bit more useful, but I think it's also a trade-off in terms of the edge that you have in day trading. If you're scalping, Keith has found that a 4-minute chart is slightly nicer than a 5-minute chart, especially using this indicator. Next, he's also included this dynamic yellow average line inside of his code, which we'll be using as our starting point. And so we'll be looking to see whenever that crosses above or below our traditional overbought and oversold areas. And this is in different from the actual RSI line. This is a different yellow average line, which is far slower. And so when this crosses above or below the oversold, overbought areas, that tells you that there's emphasis in the move. And finally, Keith has talked about how this dynamic RSI adds confidence to the existing volatility box trades. At least for those of you watching that are volatility box members, you can see how this not only helps validate trade ideas that set up, but it also opens up this avenue for a whole new set of trades that you might be willing to take if you're a more aggressive trader, especially when the market is chopping sideways, right? And so a lot of times, if say our volatility box edges are here, price is really just kind of moving around here, and we don't really have any sort of edge. For those of you looking to trade more often than not, this may then give you some opportunities where the volatility box gives you information, or even that gray line starts to give you information and overlaps with existing setups. Okay, so let's just start by looking at Keith's chart. So I'll layer on my own commentary, but we'll mostly focus on using Keith's. Okay, so anytime there's a yellow circle, these are all drawn by Keith and these are his charts, but let's take a look at what happens, right? So there's our short into what would have been our volatility box, but we can also see that in the RSI case, the RSI, which is this yellow line, is broken outside of the Bollinger Band, which is this red line. And that's what Keith has sort of introduced into a traditional RSI, is not only a Bollinger Band, and then we look at them in a few different ways, which we'll talk about in the coding section. Right? And so now we just keep looking at times where the RSI has broken outside of the Bollinger Band, and then we look up to see what sort of happened. So now, in this case, this is where price then ended up having its puke. And so this was the signal. And for us, this would have been where our entry actually is using the volatility box. And we can see how our RSI in this case then broke below the Bollinger Band on the bearish side, giving us our bullish entry. And while we didn't actually fall down to our cyan entry line, we did come to the gray dash line. And that could again be just construed as a more aggressive trade. You may still be waiting for the cyan entry line, but that may give you more confidence. But really, it's about observing this pattern of what happens when the RSI breaks outside of the upper Bollinger Band, right? And it happens to be sometimes we're conveniently in nice spots near the clouds or any sort of entry lines. You may be near one of your own support lines or edge lines if you don't happen to have the volatility box. Really, it's just some sort of edge parameter that gives you a defined price level, which you can then overlap with these overbought, oversold areas. So let's move on to the next chart. So something similar here, but in this case, we can see that the RSI broke above the yellow average line, and right at that point, we had a pivot up higher. And then here we can see once again that same pattern that we talked about, which is the RSI breaking above the upper Bollinger Band, and that then led to a bearish move down lower. And then once again, we broke outside of the Bollinger Band right here, and that you then had a divergence before an ultimate move up higher. And this is all Keith's commentary, but if we just observe this, what we're trying to get out of this is patterns or repeating patterns that happen. And so far, we have the idea or the relationship between the RSI and the Bollinger Bands. We've also just observed the relationship between the RSI and the yellow line for the first time. Let's keep going. And so above, you can read some tidbits from Keith's email. I won't read these out loud. You can always pause and read if you'd like. But what we'll look at is the actual chart. And so what you can start to see down here below is there's a lot of white lines. And these white lines are those trend lines that Keith draws on his charts to help define support and resistance. And you can sort of see where you as a user might be a little bit overwhelmed trying to do something like this, especially on the go. But that's where we've automated this process. But it's the idea of then looking at trend lines and looking at bounces as areas where you're looking to then buy. And then looking at areas of resistance where you're then looking to sell, sort of like a traditional trend line. And that's really the takeaway from this chart. It's starting to observe that now we've added in trend lines, and trend lines are now starting to act as support and resistance. The same way you'd be using it on a normal chart. Same sort of concept here, right? We see a bounce right into the trend line. That's then your opportunity to short. And then you have another bounce. Then you have another bounce, and then you finally have your break through the trend line, and this is your signal to then sort of be looking to go long. And then another point that Keith often talked about is the idea of a retest. So more times than not, he says, once you break through this trend line, you would then come back retest, and that is then your conservative point of entry if you're a bit more of a conservative trader. You can see in this case, however, we didn't really get that retest back. But again, for this to happen, you need to have been consistently drawing these trend lines as the market is moving. And that could then be, a person can draw a trend line a million different ways. And so that's where the automation of this was pretty crucial. Continuing down the charts, again, you can see same sort of trend line concepts, right? It's trend line support where you'd have an opportunity to sell, same thing. Then you had a break above, and this is where then you're looking to reverse. And again, you had to have been drawing this trend line for this to have been possible, which is what Keith has been doing. You can pause these charts, but you'll notice something very similar, right? And Keith's commentary sort of says it all. It's when you have tests and when you have breaks. And so far we have the ideas of the RSI outside of the Bollinger Bands. We have the idea of this yellow average line having some sort of significance. And maybe we'll use this overbought and oversold lines to try and reduce the amount of noise we see ultimately, because we'd always like to see fewer signals and more signals, but more accurate signals. And then we also have this idea of using trend lines as retests and areas of breaks as ideas of breakouts. But again, this requires more work, and this is a bit more noisy and more for the active trade. Same thing on the Dow, same thing on gold, and then you can pause the video if you'd like to read some of his commentary, look at the charts and look at the setup. But for the purposes of just keeping the length of this video shorter than longer, I'll just keep breezing through, and then I'll cover the points where now we have ideas of concepts, right? And it's the idea of retest, which we talked about, but we're looking at breaks. This is a picture perfect example of where Keith would then say that this is your conservative entry to then go long, right? And using our volatility box, if we extrapolate it, and we've seen this happen plenty of times where the levels extrapolated into the next hour still hold up almost perfectly, but we personally don't have a setup for that because our edges at that point have shifted. Well, if you were a bit more aggressive, then you could start to layer on things like the RSI to find trades, at least scalping opportunities that otherwise don't exist in terms of our traditional trade plan. Right, and here again we see some more commentary. It's the times to short or when the RSI hits our upper Bollinger Band concept we've talked about, and then a good time to cover that short is when the RSI hits the lower Bollinger Band or reverses above the median line. And this is where we start to see that this yellow median line has a little bit more weight. And then we also see that you can start to use this pre-market to gauge some information around what's happening in the markets. And so here Keith has a chart of the Russell, a longer trend line, but we have an earlier break signal before even we break outside of price action. And then we again had a same sort of test right back here. Let's keep moving along now to the second portion of the tutorial, in which we'll take all of these observations that we've been talking about and translate them into code. So before we do that, let's start by first reviewing the relationships that we'll be focusing on, at least for the portion of this tutorial, and then hopefully the previous section with all the charts and the commentary gives you an idea of some additional relationships you may want to focus on if you find that this indicator adds value to your trading. So the first one that we'll look at is the relationship between the RSI and the Bollinger Bands. And the second one that we'll take a look at is the relationship between the yellow dynamic average and then the overbought / oversold levels. And these are your traditional 70-30 levels on the RSI. Then we'll take a look at the relationship between the upper and lower Bollinger Bands, which we'll use to measure whether or not there's a squeeze, at least according to the dynamic RSI. And then finally, we'll introduce in some code that automates trend lines and start to use that to see if there's areas that we can identify support and resistance. We'll start with the RSI and the Bollinger Bands first. And so for us, based off of our charts and the examples we showed, for a bullish signal, we want the RSI to have crossed below the lower Bollinger Band. And for a bearish signal, we want the RSI to have crossed above the Bollinger Band. And then what we'll notice as we go through this exercise is when we first add just the following two conditions, there will be quite a few signals that populate. And so then the follow-up question becomes, how do we eliminate these noise if these conditions are true too often? And so for the relationship of the RSI and the Bollinger Bands, we'll only display this on our upper study, not our lower study. And so we'll start by first creating our very first code, where we'll copy in Keith's code, and we'll name this the upper study. Okay, let's get started. We'll start by clicking our studies icon, and then click create, and copy and paste in Keith's original code that he sent us. And for those of you following along in the tutorial, this is available on the website if you'd like to take a look at the actual code. And so here we'll have the name TI_dynamic RSI, and then we'll call this upper, and we'll make sure we change this declare variable up here to say upper. And now if we just scroll through the code real quick, we'll see we have all of our global variables up here. And then as we go down, we have each of the different lines plotted in which we have our dynamic RSI. Then we actually have the RSI line, each of our middle lines, which is our plot. And then we also bring in our Bollinger Bands along with our oversold, overbought levels. And then we have a bunch of our formatting for each of our plots. And for our upper study, we don't really need any of this formatting. So we'll copy paste this in when we create the lower study. But for right now, we don't need any of this. We can also remove our plots here and here in which we define things like the color, or we set line weights. And the next thing we can do is, since this is our upper study, we don't want to see so many lines, right? We want that chart to be clean, and we'll change all of these plots to be def. And so these are definitions, and they won't show up on your chart, but we can still reference them for calculations. And so once we go down the line, we've now changed all of this code to be compatible for our upper study, and we've gotten rid of our plots, and we now get the error that at least one plot should be defined. And now we can move on to addressing the relationship between the RSI and the Bollinger Bands. And so if we say this is the RSI and Bollinger Band relationships, we'll just say relationships. Right, and we'll start by first defining that bullish signal that we had talked about. So we'll say bullish signal. Actually, we'll call this bull signal, and we'll say if RSI is less than or equal to lower Bollinger, then 1, else 0. Right, and then for our bearish signal, we'll say plot bearish signal if RSI greater than upper Bollinger, then 1, else 0. And then we'd also like to add in some formatting here to make sure that we've these plot as arrows, and we'll say bold signal dot set painting strategy to painting strategy dot boolean arrow up. We can close that off. And then if we copy paste that in one more time, and we can change the bull to bear, and then we'll change our arrow up to say arrow down. Right? And now, if we click OK, hopefully what we should see are at least some arrows starting to populate on our charts, which we do see. We see a bunch, actually, and this is what we were talking about. If we just look at the conditions to be true on their own, we'll see we have a lot more noise here, and it's just really hard to take every single one of these signals, and then you're suddenly playing the game of, oh, which signal is accurate, which is not. So let's let the code address that question for us. And if we come back in here, for our bull signal, let's continue to add in some more filters to try and eliminate some of this noise. And so the next one that we might want to look at is to make sure that the Bollinger Band, in the case of a bullish signal, is above the 50 mark. We might even go so far as to say above 55. And so we might say if upper Bollinger is greater than or equal to 55, actually, correction, this should say if it's less than, and this is if our lower Bollinger is less than or equal to 45 in this case, because we want it to be below 50. And then we'd like the RSI to then confirm, so be below our lower Bollinger Band. And then we might add in even one more condition where we look at the RSI in itself, and we want this to be, let's say, in pure oversold territory. Right? And so we'll say it has to be less than or equal to 30. And then we'll go ahead and add in these reverse conditions for our bearish signal. So we'll say upper Bollinger has to be greater than or equal to 45, and we'll actually go ahead and add in some space here just to make this readable. And then we'll say if our upper Bollinger Band is greater than or equal to 55, and our RSI is greater than or equal to 70, so we know we're in oversold area, and our RSI is above our Bollinger Band, then 1, else 0. And now if we just take a look at the chart once we hit apply, we can see the number of signals is drastically reduced. And whenever we do get these signals, especially when they overlap with our volatility box, they turn out to be really, really nice, strong signals, right? We see we had our first signal populate here, then we had the entry near the volatility box. This is in that first hour when we're not looking to trade gold. But all of a sudden, you might have some more confidence trying to take this trade. Now, if we come back in here, we can see that we've introduced in the RSI and the Bollinger Band relationships, and then we can continue moving down the next relationship that we'd like to address. And so if we bring back our PowerPoint, our next relationship that we have is between the dynamic average and our overbought oversold levels. And here we're really looking at a few things. We're looking to check when our dynamic average crosses above into overbought territory. And then we're also going to take a look when our dynamic average crosses below into oversold territory. But now, this is an interesting question that Keith had raised, which I think he added into the code and turned out to be really useful, which is we know when we might enter our overbought territory, but isn't it equally useful and just as important to know when we're exiting that territory, right? Everyone always talks about, okay, we're entering overbought territory, entering, but it's just as important to understand when we're exiting so that we can start to look at this almost like a train leaving a station. It's coming to the station and then it's leaving the station, and we know what our period of window is when we might be looking for an entry. And so if we try and include this dynamic average into our indicator, we'll come back to the code, and this time we'll add in dynamic average and we'll just say overbought, oversold relationships. And here we'll give this the name super overbought, just to kind of keep up with that dynamic average having more weightage theme. And we'll say is equal to dyn average, which is the variable name that Keith has given right up here. If we take a look, dyn average. And so we come back down here and we'll say crosses. So if dyn average crosses above, and he's already defined overbought, and so we can actually just even reference it as overbought, then that would be true. And then for oversold to be true, we want the dynamic average to cross below oversold, right? And so that now gives us our entries into each one of these respective areas. But we also talked about how it might be equally useful to take a look at the exits. And so we'll create new variable names. We'll say des super overbought exit, and we'll say that this is equal to dyn average, and it's just a reverse, right? It crosses below over bot, and now we'll say def super over sold exit dyn average crosses above over sold. And now we have both our entries and our exits, and we'd like to plot this. And the means that Keith and I chose to plot this on our charts is just by using simple plain English through chart bubbles, right? And so if we take a look at how we did that, we'll give it add chart bubble, and we'll give the first condition. So this is the conditions. The first parameters are the conditions that need to be true for this chart bubble to even populate. And the only time where we want our entry chart bubble to populate is when we're entering overbought territory and we haven't previously been in overbought territory. So it's really the first time, and it's when that train is entering the station. And so if we take a look at what that code looks like, that would be super overbought, and then that needs to not have been true in the previous bar. So this tells us that this is the first time that this is a true condition. So we're just entering the station. We'll plot this just with the close, and we'll say enter super overbought, and we'll give this the color of light red. So if we close this up, that perfect. So that compiles without any errors, and we'll go ahead and do the same thing, and this time for the super oversold. So we'll say super oversold and not super oversold on the previous bar. Close, enter super oversold, and then we'll give this a color light.green. And we'll make the two separate colors so both our entries and our exits stay together, and we'll just segregate them by giving one a light color and then one a darker color. Right? And so now if we do our exit chart bubbles, we'll say add chart bubble, and this time we'd like to see super overbought exit, and this was not true on the previous candle. And then once again we'll plot it, and this time we'll say exit super overbought, and then we'll give this the color of red instead of light red. And then if we copy paste this code in one more time, and this time we can come in here and we can change the super overbought exit to super oversold exit. And then same thing, we'll change the spot to super oversold. And then here we'd like to say exit super oversold. And then we'll change the color from light green to green in this case. And so now if we click apply, on our charts, we can very clearly see when we're entering and exiting a super overbought condition, and this is using the indicator. And we can start to see this across all of our charts. In the case of gold, we haven't hit any oversold areas, but we have very clearly seen when we've entered and when we've exited super overbought conditions. And on its own, each of these pieces doesn't give us too much information, but it's really when we start to bring everything together, do we start to have some meaningful information that now lets us start to trade. And so if we come back to our presentation, let's keep moving down the relationships that we're studying. So the next one that we said we'd take a look at was between the upper and the lower Bollinger Bands, and this is what we called our squeeze. And for the squeeze, this is the first study which will be on both our upper and lower studies, and so this will also force us to now come back, copy paste in the code one more time, this time creating our lower study. And what we'd like to take a look at is when our upper and lower Bollinger Bands compress. So they're coming together, and the way we'll define this is when the distance between them has started to shrink, and this is what we'll define as our squeeze. And the squeeze plus sideways action, or maybe confirmation with another one of your squeezes that you may be looking at, whether it's moving average based, whether it's a TTM squeeze, whatever it may be, may start to give you just more confidence and more confirmation of the signal either being validated or invalidated. And finally, as we talked about, this is that first distinction between our upper and lower studies. But now the question comes, okay, so we have the squeeze displaying on both sides. How do we present this information a little bit differently in both sides? And so we'll take a look at how we may do that. We'll be using that same plotting strategy of using the squeeze dots, but we'll plot the dots on our upper study and we'll plot the dots on our lower study. But hopefully what we'll see on our upper study is if we have some of those dots around some other signals, then that might give us an indication as to which way the trade might fire. And so bringing this back to the charts, we'll come back to our study and we'll first edit our upper study with the squeeze. And then we'll go ahead and add in, copy paste in all of our code and then re-add the squeeze code in for our lower study. And so here we'll call this squeeze relationship and we'll say lower and upper Bollinger Bands shrinking, or actually let's say compressing. And the way we'll take a look at this is first we need to define a variable in which we're measuring the distance between the upper and the lower Bollinger Band. And if you take a look at the charts and the studies, it's up to you to create what you might consider to be a distance in which they have been compressing. For us, we use just 10. It's a sort of nice, clean, arbitrary number. And looking at the actual charts of the Bollinger Band on the RSI, we saw that more often than not, 10 was a good period of just compression. And so if we want to try and translate that, we would say def, or definition, and then Bollinger Band distance is what we'll call this. We'll say if our upper Bollinger minus our lower Bollinger Band is less than or equal to 10, and so this is to say the distance between them is less than 10 wide, then return true, else return false. And then we'll go ahead and actually plot this as well. So we'll say plot squeeze. We'll say if this condition is true, then we want to plot this in our upper study at the close. And then if it's not true, then do nothing. And we don't want it to plot. We don't want it to be plotted at 0, but rather we want nothing to show. And for that, we'll put a double dot NaN. And then we can go ahead and set our painting strategy for the squeeze. So we'll say squeeze.set painting strategy, and we'll say painting strategy.points. And then we can also give this just a little bit of weight. So we'll say set line weight, and we might give this a weight of 4. And we'll give this a default color of the squeeze color, in which we'll say set default color color.red. And hopefully what we see on our charts, is periods where we have these red dots, which tell us that according to our RSI, we have a squeeze building up, right? And so if we just take a look right here, these are the two conditions where we had a squeeze building up. And we can see we ended up chopping sideways, sideways, sideways until ultimately falling down lower. Here we again saw our squeeze signals populate, chopped a little bit of sideways before making our thrust up higher. Going back on the charts a little bit more, very similar thing, right? Squeeze consolidating, consolidating, thrust up higher, and this ultimately led to that move that we continuously have seen so far. And this is off of a 4-minute chart. Same thing here, squeeze, compression, 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 and then we have this puke down lower, which ultimately leads down to an even greater puke down lower. And same thing up here, compression leads to thrust move up higher. And now we'll go ahead and create our lower study as well. And so the way we'll go ahead and do that is copy paste in the same code that we used to first create our upper study. We don't need the bullish or bearish signals, but here we can say TI and we'll give this dynamic RSI, and we'll say lower. And this time at the top, we do in fact want this to say declare lower. We can change this to say, again, Keith C, and we'll change the headers when the code is actually distributed. But this time we do want to leave all of these plots in, right? We want to see all of these values at the bottom. And now we're just going to go ahead and add in our squeeze code. And so if we just click OK, this should create the indicator. And now we can copy paste our squeeze code from our upper indicator. And so we'll just copy paste this into our lower indicator. And the difference that we'll have here is in our upper indicator, we plotted this on our close. In our lower indicator, we don't really want the value of the close because our lower indicator is using that 0 to 100 scale for our overbought to oversold conditions. And so instead, we'll just plot the smack dab in that middle line at 50. And we may also want to change this line weight. We'll leave it to 4 right now, but if it becomes too thick or you want to change the colors, then this is where you could come in and do it. So now if we click apply and OK, and we hit apply on our charts, you'll notice that we've now created this lower study, quite a few more lines, but we can see the same sort of squeeze dots, and now the dots above and the dots below should hopefully start to give you some sort of an idea, because now using the dots below, you can see that, okay, the RSI is more likely in overbought condition, suggesting that we may make a move lower, and you may have been waiting for this RSI to cross above the Bollinger Band, at which point one of these arrows would have populated. That did not happen here, but again, depends on how aggressive you may be as to whether or not some of these are entries for you. Okay, so now that we've added in the squeeze, the final thing left is all of our studies around trend lines. And this is the part which is a little bit more challenging than not. And so we did some Google searching, and we ended up finding this code written by a famous thinkScripter by the name of Mobius. And he shared it in a forum, and we took a look at that trendline code, and we tried to adapt that same trendline code into this dynamic RSI study to try and help us solve this idea of making trend lines objective. Right? And you can take a look. We have a link to the code in the actual code download file. So if you'd like to look at sort of Mobius's idea behind it, and then there's some very interesting discussion on that forum post as well, then you may be interested in taking a look at that code. But we'll try and bring in Mobius's code, and you may notice that you'll find a lot of thinkScript code over the internet. A lot of it may help you achieve some of the functions that you're trying to do, but it's really about just understanding what the code is and then adapting it to try and morph it into code that works with this current indicator. And then finally, we'll try and create some chart bubbles to identify whenever we touch this trend line as areas of support, and then you may be looking visually to try and identify areas of breaks. So coming back to our indicator, for our trend lines, we only want to see this in our code below because it is a little bit messy. So we'll open up our lower indicator file, and then we'll go ahead and just copy paste this code in. Again, this code is available on the site as well for those of you following along. And so we'll copy paste in the code in a way that it doesn't break this file, and then we'll talk about what we changed. Okay, so once it's copy pasted, you can see we have some pretty clear headers here. And so if you'd like to take a look at where you can learn a little bit more about this code and just the idea that Mobius had when he created this automatic trendline code, which by the way was meant for price action up on your charts above, and we've sort of taken that concept and tried to figure out, okay, can we now apply it to our lower charts and use the RSI instead of price action? And that's exactly what we did. And so everywhere where you see RSI here is where they were looking at plotting using the close, using the lows, using the highs, and using the wicks of candles to try and calculate what might be essentially a trend line, and instead we use the RSI values. And that's what we've changed. And then another thing that we added in is variable 0.8, in which you're changing the sensitivity of these trend lines so that you might make this a little bit more relevant as to what we're looking to do. And then we also use the values 150, 80, and 40 for our trend lines. But what you may notice as you play around is that there's some values that you might like a little bit more. But for us, these are the values that we've chosen right now. Right, and so each one of these distances, just to cover what these values are, suggests the how far back the RSI goes to try and determine from which distance should it be drawing a trend line. So obviously trend line 1 is going to be your sort of widest, most conservative trend line, so bounces off of that would be fewer to see, especially because bounces to that trend line would suggest that price has really fallen off. But whenever you do see those bounces, there might be places where you call really conservative entries, or it might even be points at which breaks have happened on the next two trend lines. Our next two lengths are 80 and 40. And so for the actual code that we'll be writing, we'll take a look only at the middle mark of 80. But if you'd like to copy paste the code and see these alerts for all three lines, we'll show you how easy it is to do that. So now if we come in and we just take a look at what this code looks like on its own, we'll click apply, click OK, and you have to scroll all the way to the right. And what you'll notice is there's automatic trend lines drawn on your chart using this indicator, right? And so we have our fastest, our middle, and then our slowest trend line. And it all depends on which bounces you might be looking at trying to trade. But all of a sudden now, these trend lines are automatically drawn for you. You may want to format this chart. You may not care to see whether or not the Bollinger Bands and the RSI is actually above, because you might outsource that to our study above, which is always measuring and will plot an arrow just like this anytime our Bollinger Band or our RSI is above our Bollinger Band. So you may try to clean up your charts that way. You may only have the RSI along with these trend lines plotted. You may not even need the yellow moving average if you didn't care enough to see it. And so we'll show you just a few different variations of how you play it. This is how Keith's charts look, and he's perfectly okay. And he's actually developed a really good system looking at all this information and digesting it. But I understand that some of you may not. And so we'll take a look at how we can just make this a little bit easier on our eyes. But first, let's go ahead and take advantage of this trend line code and create our signals. And so we'll have just some very simple code. We'll say trend line signal, and this will be if our RSI is greater than or equal to trend line 2A, then 1, else 0. And then we'll repeat the same thing, trend line signal 2, actually we'll say trend line signal B, and we'll say if RSI is less than or equal to trend line 2B, then 1, else 0. And now that we've written this code, let's cover very quickly what this does. And so this tells us when our RSI line is coming down and it's touching that second trend line, almost giving you the opportunity to buy off of support. And so this is our buy, or essentially our bounce into support. And then this is our bounce into resistance. And we may want to make that a little bit more clear. So we'll just say trendline signal short, and we'll make this long. And if you would like to say take a look at this on all of the trend lines, it's as easy as copy pasting this code and changing that 2A and 2B to say 1A, 1B, and then you may add one more, which also takes 3A and 3B. Completely up to you. We're just going to leave it with 2A and 2B for right now, just because it keeps your charts a little bit cleaner. And the way we'll plot this is using a chart bubble again, except this time it'll be on our lower indicator, and we'll say if we've had the trend line signal to go, let's say, short, and this signal was not true on the previous bar, so trend line signal short, then we would like to have this plotted on that actual trend line in itself. So this is trend line 2A, and we'll say short, and then we'll give this the color of red to imply that it's a sell. And we'll go ahead and repeat the same thing, so add chart bubble, and this time we'll say trend line long, or signal long, and not trend line signal long on the previous bar. Then trend line 2B, and this is the bottom, and we'll say long, else color in color dot green. And now if we click OK, what we can see, and this is just beautiful, right, is we have very clear chart labels that takes out any guesswork that now tells you that this is a place where you're bouncing into a trend line. So this is an opportunity to go long. This is an opportunity. Oh, do we reverse them? I think we reversed them. And so we'll just come back in, we'll reverse these. So we'll say if this is actually long, this is short, this should be color dot green, color dot red, and each of these names should also be reversed. So we'll just give this long and we'll call this short. Right, and then here we'll just make sure we replace each of these variable names to fix that error. And if we click OK, that should now look more like what we're hoping to see. So now let's take a look at this on charts. And instead of gold, let's go on to something that I think a lot of people like to trade, which is, let's say, the S&P. We'll zoom out. We'll just start from the beginning on a 4-minute, I believe 5-day chart, right? And so if we zoom in, okay, so here we have a few different squeeze dots plotting. We see price sort of starting to consolidate here, and then that ultimately led to a really nice move up higher. And so here we see that the squeeze did in fact help us sort of give us an early indication as to a move that's coming in. Then we had our entering super overbought conditions. Then we knew when the train was leaving the station. And if we zoom out, we can see that after this condition is where price then really just, after our exit, we fell, came back up, retested, came back down, retested a third time before ultimately falling down lower. And looking once again, entering super overbought. Once we're exiting super overbought, we can see that the train continued to go downhill. We can also see we had a squeeze ticker here and a squeeze dot here. And so here we just start to see S&P starts to chop, really chop to sideways. I would say that this squeeze really didn't pan out too much or give you any sort of real information, which is where layering on multiple squeezes starts to give you an idea. We can also see that our bearish signal here populated, and if we zoom in, using that bearish signal, you then had a nice flush move down lower, and the volatility box gave you an idea as to where price might start to exhaust, which is exactly where it started to exhaust, and then reversed. And so scrolling down through, had another bullish signal here along with the squeeze. And so this might have been sort of your overlap, which tells you that you're starting to look at the S&P maybe in a bullish breakout scenario. Keep in mind the time, however, this is close to noon Pacific, so really just 1 hour left. And this would have been a play off of a 4-minute chart. Not sure that you may have wanted to take this headed into the close. Looking back once more, another bullish signal here with a nice move up higher. Another bullish move signal here with a really nice move up higher, and then a bunch of squeeze dots that populated here, another one that populated right here. And then if we take a look to see what kind of move actually took place, our last signal was a bearish signal right into our volatility box, giving you a nice opportunity to short. Not really too much of a move down further, consolidation, 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 and then bam, you had this huge move down lower. And then you had an opportunity to buy this dip, and we had our bullish signal go off here as price fell into our volatility box, contained it, and then we had this nice cup and handle reversal. And we can also see when we're entering oversold, so the train was now just coming to the station. If you're using this as confirmation, then it's really after this point that which you're starting to look at an entry to go long. And so that would have helped you get even a better entry on the volatility box. Again, this is in the middle of the night, so just keep that in mind. But then the train is now leaving the station, and so as we continue to then go up, we zoom out of our charts, we take a look at the price activity that has now continued. All right, and then so once again, then the S&P opens, we start to fall down lower. We're entering or approaching our aggressive volatility box. We don't have any signals plotted yet. Then we get our first signal entering super oversold, and this is at which point you may start to look at entries. Right? And then we just keep looking, more squeeze dots, and this squeeze ultimately ended up firing long, and you ended up having a nice flush up move higher in the afternoon hours. And then we had our bearish signals plot, and if we zoom out and we take a look to see what happened with those bearish signals, the S&P then ended up just staying sideways really for much of the night. Then more bearish signals plotted into the morning hours before we ended up ripping actually higher. And then this is Friday's activity. And so that's looking at it on the S&P. And then finally, let's just apply this on, let's say, something like the crude futures. And we'll come back to the same 4-minute chart. And like this, you may try and apply it on whatever time frame chart you take a look at, right? 4-minute happens to be what Keith suggested to us, and that's what we just happen to look at. But here, once again, we'll actually this time focus on the signals that happen during market hours for the most part. And so we have our bullish signals entering super overbought, and then we know when the train is leaving the station, and then as soon as it leaves the station, we get this massive puke down lower. This is our first confirmation letting us know that we're now entering super oversold territory. And so traditionally, our entry was right here, and this was then that stop out that we actually incurred. But we can see how if you are a super conservative trader, you might actually be waiting for an oversold level before you're then looking at the volatility box as an entry. And so this might have actually been the place where you might have looked at for an entry, using the right outside edge of this volatility box as your stop. And if you looked at this as that sort of a trade, then this is a beautiful follow through for yourself. Far fewer entries though. And if we just keep going down the charts, right? We'll just keep a focus on times that we're actually looking to trade. Had a bearish signal, small reaction down lower. Had a bearish reaction, small reaction down lower. Then more squeeze, or only one squeeze dot, but this ended up giving us just some chopping sideways move actually. Then a bullish signal right into our volatility box, but this is after hours when we're only looking at the conservative volatility box. Then only one squeeze dot. Then another bullish signal, which gave you just a really quick, nice follow through if you happen to be a fast trader. Then more squeeze dots, and this is into the close until we ultimately had this nice move up higher, once again into the afternoon hours. And now a full day, once again, we have our bullish signal. Our closest context edge entry is our volatility box. We also have our enter and exit overbought, oversold conditions. And now if we just come to Friday's action on crude, we can see this is where we entered. This is where the train left our overbought condition. And then it continued to then go back to climbing up higher. We had squeeze dots, much easier to see right down here. And then using our actual trend lines, this was where we had the opportunity signal going long. And again, this is just looking at it in hindsight. And so you have to observe these trend lines in real time, depending on where they're drawn. But you know that at least a second bubble would have plotted, which was then your opportunity to go short, assuming you were looking to trade on a Friday afternoon, which we're not. But hopefully you can start to see how this RSI, along with this automatic trend line, along with our arrows here, just give you information, and then you can layer it on to any sort of edge levels you might have. You might be using moving averages, you might be using other areas of price exhaustion, whatever your definition is. But this starts to help you act like a filter and then find a few more opportunities that you might be looking at trading. So hopefully this indicator provides some value in your trading. I'd like to thank Keith once again for all your detailed explanations, patience, charts, all of that good stuff. I really appreciate it. Here's some trades, just some live screenshots that he shared. And so this was your really nice, perfect overlap with our bullish signal and also just our volatility box line. And you may continue to tweak these settings, modify them based on sensitivities that fit your trade style a little bit more, right? The more aggressive trader might be using less filters. The more conservative trader might add even more filters. It's really up to your trading style, but build a plan, work with that plan, and hopefully I think this indicator should start to provide some value in your trading, at least over your basic RSI. Once again, thanks for watching the 10th episode of How to ThinkScript. This tutorial was a bit longer, but I hope that it provided tons of value and all of these concepts helped you learn something at the very least, if not providing you with a new indicator that you might use in your actual trading. Shout out to Keith for this tutorial and for this awesome work. I really appreciate it. Thanks for being an awesome member. And we hope you all learned a lot in this tutorial and enjoyed it. If you'd like to download this file, it's available on our website for free along with that PDF that Keith built, that one pager. And so both of those files will be there. Download them, use this indicator, comment if you find anything interesting or any interesting use cases for this indicator or timeframes that work for you, or maybe setups that you found that we may have not even discovered ourselves. It's all about collaboration, and that's what this community is for. Thanks, everyone. We hope you enjoyed the 10th episode, and we'll see you in our 11th episode. Take care.